All right, we want to welcome everybody today for the tax team webinar that we're doing. I'm here with Toni Covey, one of our EAs here at DG Anderson. My name is David Gass, and today we're going to talk about tax returns and looking at your individual tax return, kind of seeing what, from a business perspective, what ends up showing up on your tax return. I know as an entrepreneur myself that there's times where I kind of wonder where all these numbers actually end up, right? And so they show up in different places. So first off, welcome, Toni, for coming into the tax team webinar. Thank you for joining us.
Thank you for having me.
All right, so to start off with, one of the things that has come up, and I've asked people this before, because I am not from the tax world and I'm not a CPA, so I didn't quite understand how all these CPA, EA, DDBBA, whatever they are.
Right.
So give me an explanation of what an EA is, because that's what your designation is, right?
Right. And it's like you were saying, everybody pretty much knows what a CPA is, but people aren't as familiar with EAs or enrolled agents. And basically an enrolled agent is a person who has a privilege of practice before the Internal Revenue Service, represent people before the Internal Revenue Service. How you get the designation is a three-part examination administered by the IRS. And much like a CPA, EAs are required to maintain continuing education. So basically, in a nutshell, an EA is a tax specialist licensed by the IRS.
So you've had to do a lot of classes or a lot of time learning about what the tax code is and all that fun stuff.
Yeah, that was a lot of time learning about tax law, ethics, and just individual and business tax returns. Like I said, go through the three-part testing, and that's how you get it.
So can anybody prepare a tax return?
Well, yeah, anybody can prepare a tax return as long as they get a P10, basically a registration number, if you will, with IRS.
So when we look at that, I mean, what you're doing is, so if I walked in, I don't know, to H&R Block or one of these ones that are out there, they have people that are preparing tax returns, but then there's a designation up from what they are potentially, and I wouldn't assume that all of them are EAs or CPAs,
No.
right? And then you have a little bit higher level person, which is the EA, and then there's the CPA,
Exactly.
right?
Exactly.
Okay, that makes sense. All right, so as we dive into the kind of the nuts and bolts of all of this, what we're wanting to know is just give us all an explanation of kind of how different types of structures and from a business perspective, how things show up on your personal tax return. So let's start off with looking at, for those who may be using the sole proprietorship, and then let's dive into the disregarded LLC as well.
Okay, well, there are business activities, business entities that will affect your tax return, your personal tax return, which is the 1040. It'll affect it directly and indirectly. Two things that will affect your tax return directly is going to be a sole proprietorship. It's 100% solely owned by yourself. It hasn't been registered with any state as a legal entity. So you're reporting that activity directly on your tax return. Any income and expenses in relation to that business activity. The disregarded LLC, which you're actually going to hear LLC throughout this whole thing, because the LLC, one of those rare entities that can actually be taxed as a C corporation, S corporation, partnership. If it's just you, you're 100% owner of the LLC, or perhaps a married couple, that's going to be called disregarded or classified as disregarded. Basically, in the eyes of IRS, it doesn't exist. It's just, as far as the income and expenses go, it's going to be reported directly on your tax return.
So just to clarify that, so on LLCs, limited liability companies, we're talking about a business structure that we tend to know as we file it with the state. We've got all the asset protection geared around that comes with an LLC. But now what we're doing is we need to look at it and say, okay, from a tax perspective, it's taxed in different ways. So how we do that, my understanding, you tell me if I'm wrong because you're the expert here, but is with the SS4 form, initially we're on that SS4 form, which is where you get your employer identification number. we're indicating how we want to be taxed.
Exactly.
Is that right?
Exactly.
So in that, you're saying there's different ways you can be taxed as an LLC.
Right. Yes, that's exactly right. On the SS4, that's where you're going to initially say, I'm going to be a partnership. I'm going to be taxed as a partnership. I'm going to be taxed as an S Corp or a C Corp. However, even after you file the SS4, if it's just you and you didn't say specifically you want to be a partnership, there's going to be another person there. You're going to have to file another form in order to be taxed as, I think I got off topic here. We were talking about disregarded LLCs, and I was just about to tell you how to be an S corporation.
Yeah. No, that's okay. So, but what you're saying though is from a disregarded LLC, if I end up saying, hey, I want to be taxed as a C corporation or an S corporation, I can do that on that EIN. But how do you show that you're a disregarded LLC? I mean, do you just put down, I want to be taxed as a sole prop, or how does that work?
You don't put down that you're going to be taxed as a sole proprietor. It's basically an other box on the form, and you just put
other.
You just put disregarded. IRS will automatically, if you don't check any of those other boxes, IRS will automatically have you registered as, when you get your EIN, as a disregarded.
Okay, and so disregarded just means that I do not have to file a tax return for a specific tax return that's separate from my personal return.
Right.
Okay, very good. Sorry to get off topic on disregarded. I've never really quite understood the disregarded piece, and so I always find it very interesting when I'm learning something myself. So that's good. So on a Schedule C, is this Schedule C, Schedule E that we're talking about, these are schedules directly on which return? Your personal?
1040.
The 1040, okay.
The Schedule C is basically where you're going to put any activity you have that's a for-profit business activity. For-profit being the key, which we're going to talk about the hobby loss rules a little bit as well. Any income that you have with regard to that activity, you're going to put that on your Schedule C. Any expenses you had, you're going to put that on your Schedule C. The net income from that is what you're going to report on the front of your 1040.
And the SE in here, net income subject to SE tax.
Right. That is a very important point. That's self-employment tax. When you have a business you're reporting on your Schedule C, and it's starting to have a substantial amount of income, you might want to talk to one of the attorneys and think about changing that up, because you are going to be subject to self-employment tax on that income. Which is how much? 15.3%.
Okay, which is significant. I mean, that's right. So you're okay.
I mean, another good option for that would be perhaps an S corporation. I mean, like I said, you just want to talk to one of the attorneys, because first of all, you really don't want to be a sole proprietor conducting any business activity. And the self-employment tax is just, yet another reason why you want to look into perhaps structuring some sort of business entities.
Got it. So tell us about these hobby loss rules.
Well, here's the good thing about the Schedule C. The Schedule C losses can be deducted against your ordinary income. So if you have W-2 income or anything like that, your Schedule C losses can be deducted against that. However, you do have to be a for-profit business. So basically, if you have losses in 3 or more out of 5 consecutive years, you're deemed as a hobby by IRS, or at least you can be deemed.
I was gonna say I've seen some publicly traded companies that are losing money 3 out of 5 years. They aren't considered hobbies.
Well, see,
right?
That's a publicly traded company. They have different rules.
Okay.
This is a sole proprietorship.
Related specifically to the type of entity.
Exactly. So that's another reason why you might want to look at, well, while those losses may be great and you can take them in perhaps the first 2 years of business, if you continue to see losses on your Schedule C, that's when you need to say, hey, maybe I need to put this in a business entity, because now those losses are going to be disallowed because you're going to be considered a hobby at that point.
So there are businesses that, I know friends of mine that have lost money 4, 5, 6, 10, 7, 8, 9 years in a row,
Mm-hmm.
mainly because it isn't that they're trying to lose money in that business. They're just paying themselves a lot, or they might be expensing a lot on R&D and technology. I have one guy who's trying to create some apps for iPhones, and he's just putting a ton of money into these developers.
Right.
And he's losing money right now every single year as he's doing it. So,
well, if it's your intent to make a profit, you're just going to have to prove that and perhaps audit. However, the trigger for it is, 3 or more.
Okay, got it. So as long as you could back it up and say, like he could say, hey, look, here's all the apps and here's all the technology, here's all the stuff I've got. We just haven't rolled it out yet.
Sure.
He should be okay. Probably.
Sure. Yeah.
Okay. So in Schedule E, give us an explanation of the Schedule E and what goes on that.
Schedule E is going to be your rental real estate activity. Pretty much the same thing as a Schedule C, except for it's specific for your rentals. So all of your rental income that comes in, all of the expenses that you have, that all gets reported on your E, it's netted and put on the front of the return. The rental.
Let me ask you a quick question on that. So real estate transactions, there's all different types of real estate transactions and different things. So Schedule E is specific to rentals only. Is that my understanding?
Well, no.
Oh, okay.
No. I mean, there's other items that would go on the Schedule E, page 1, but majority is going to be rental real estate.
Okay.
One other thing that you'd see on a Schedule E is royalties. And then you have a Schedule E, page 2, which we're going to have some activity that lands on there a little later.
Got it. Special allowance for rental real estate. Give us an explanation there. What you're talking about? 25,000 begins to phase out at 100,000 AGI. That's a bunch of not technology, but of CPA technology terms that I don't know.
Right. So,
so give us an idea what that means.
Rental real estate is generally a passive activity. However, there are some passive loss rules for rental activities. And one of those is you get to take $25,000 against your ordinary income if you actively participated. However, that does have AGI, or adjusted gross income, phase out. That starts at $100,000.
So as long if you have AGI being adjusted gross income, so if my income is over 100,000, then I can't use
the $25,000 starts to phase out.
Okay. And then exception for real estate professionals, is that what you're referring to, or is there something else?
No, this is in addition to that. If you qualify as a real estate professional, then you're going to be able to take all of your losses. It won't be subject to the passive activity rules.
Okay, so then the question obviously is, what is the real estate professional? What would be considered a real estate professional?
Basically, a real estate professional would be someone who a majority of their activity, what they do, is real estate. More than 50% of what you do throughout the year should be real estate. Specifically, you have to spend more than 750 hours during the year on real estate. So if you wanted to be classified as a real estate professional, you'd actually have to keep a log of your hours throughout that year.
Got it.
But if that's what you're really doing, then that's what you want to do, because you don't want to be subject to that $25,000 limitation. And of course, even that $25,000, as we were discussing, will phase out once you start to get over $100,000.
Got it. Okay. So next, I know a lot of our clients are using limited partnerships in different ways. So give us an idea of how that goes back to your personal tax return and what shows up on that limited partnership.
Well, a limited partnership is going to flow through to your personal tax return. And it does that. Okay, let's start here. A limited partnership actually will have to file its own tax return. It does have to file a 1065. The 1065 is going to produce a K-1 that it issues to all the partners. And each K-1 is going to be your distributive share of the partnership. So if you and I decide to go into business, we're 50-50 partners. We get our 1065 done. 50% of the income is going to be on my K1. 50% of the income is going to be on your K1. It's going to be reported on our separate tax returns.
Got it. So the K1s, just so I understand, I mean, from a 1065, if I had, let's say, $100,000 in profit in that partnership, but it was left in the partnership, I didn't actually take the money out, I still have to K1 myself or no?
Yes.
You do. So you could get a K1 for 50 grand, but never got paid anything out of that partnership and still have to pay tax on that.
Correct.
Okay.
Yes.
Doesn't sound like a whole lot of fun, but yeah, okay. Not that I want to do that, but yeah, I could see how. And there's instances where I've been in partnerships where we had that happen, where one of the partners was a limited partner, meaning that they didn't do a whole lot in it, and he wanted to get kicked back at least what his taxes were going to be due. Saying, hey, pay me at least what my tax is going to be on that money, if you're not going to kick me any money out of the entity. So I could see that being something people do. So the losses. What happens to the losses?
Okay, so partnership losses, very complex subject. It could probably be a webinar in and of its own. But there are 2 points that I just wanted to look at here, which one was that I know a lot of people deal with. One is the basis limitation, losses in excess of your basis in the partnership, not allowable. So
give us an explanation of what that means. Basis, what is basis, first off?
That's basically, I guess you can call it your ownership capital.
Okay. So what you initially put into the.
Sure.
Okay. So if we funded, you and I, you said, went into partnership together, our basis would be whatever capital we put in to start the business.
Right.
Okay. So we put in 100 grand, 50-50. You put in 50,000, my 50,000, my basis is 50,000.
And if we lost, if we had $100,000 in losses that year, then we'd be able to take $100,000 in losses because it did not exceed our basis.
Okay.
Anything above and beyond, if we just lost our shirts completely, $150,000 losses in the partnership, that 50,000 in excess would not be deductible.
Okay. So how does that work from year to year? So if we put in 100,000, is that per year or is that total?
Total.
Oh.
Total.
So over 5 years,
it's
10,000 a year. As soon as we hit our basis, we're done.
Yes.
Yeah. I mean, your limitation, whatever. Okay. So passive activity suspension. What is that?
Basically, what that is, it has to do with material participation. Losses are suspended on passive activity or passive income, until you have passive income from another activity or you dissolve the partnership.
So what is passive income?
Passive income is basically you didn't materially participate. Maybe you just invested, but you didn't have any active participation in the business. That's considered a passive activity and is only deductible. Losses there are only deductible against other passive activity income. Important on a partnership, or rather a limited partnership, because as you can see in the slide, a limited partner is considered a passive partner. It doesn't matter what they do. Okay, there are some exceptions to the rule. If you're a trader and you're a limited partner, you might qualify for an exception to that rule. General partners, active.
They're always active.
Always active.
Okay, good to know. All right, so anything else on limited partnerships, or is that the gist of it right there?
Self-employment tax on the limited partnership. The general partner would be subject to self-employment tax. Limited partner, not subject to self-employment tax unless they receive a guaranteed payment. The guaranteed payment would be subject to self-employment tax. So as a limited partner, the losses would be considered passive, so you won't get to take those. But the income, upside to that, the income for the limited partner wouldn't be subject to SE tax, self-employment tax.
Interesting. Okay, good. Anything else?
That's it for that.
That's it for that one. Okay, so S Corp, 1120S. I'm assuming what I just saw was well, I'll let you describe it. So give us the 1120 explanation.
Very similar to the partnership in that it does file its own tax return. The 1120 produces the K-1 that gets issued to all the shareholders, has the same basis limitation on the losses, and it does have the passive activity limitation. Difference here on the passive activity is that it's not going to depend on the type of shares you have. Like on a partnership, it depends if you're active partner or the general partner, or a limited partner. Doesn't matter here. Here, it just matters that you materially participated.
Got it. And so you're saying here, though, that the S Corp is not subject to the self-employment tax, but you do have to pay yourself a reasonable salary.
Right.
And the salary obviously is subject to the self-employment, or no?
No, not necessarily self-employment tax, but payroll tax.
Okay.
And no, the S corporation is not subject to self-employment tax. And here's the good part about that is, even though you do have to pay yourself a reasonable salary, reasonable doesn't mean that you have to pay yourself everything that came into the S corporation. So you might have $100,000 in the S corporation in that year, paid yourself a salary of $50,000. You're going to pay payroll taxes on that, but the other $50,000 will not be subject to self-employment tax, as it would be on the.
So just to clarify, so if I had 100,000 profit in that business, let's say not profit, but I had 100,000 that I could do with what I want in that S corp. I take 50,000 and I pay myself, and then I take 50,000 and I use that as a flow through that gets issued as a K-1.
Yes, that 50,000 that you did not put out as a salary is going to end up on your K-1.
So, and that K-1 is going to just hit my individual tax return, and I'm going to pay whatever my federal tax rate is?
Yes.
Okay, so that's just your regular federal tax rate if you're at 28% bracket, 33% bracket, whatever. That's where it's going to show up. The other 50,000, I'm paying the payroll taxes on. So what we're doing is we're saying you can take a portion of that money and not have to pay that payroll tax. You're saving that percentage on that.
Correct.
Okay. I like that. Sounds good. C corporations. Tell me on the C corporation side, it's the 1120. It says here the corporate return. So give us a little explanation on if or how this even flows through or doesn't flow through.
It does not flow through to your personal tax return. C corporation is going to file its own tax return. It's going to have its own tax liability. Or if it has a tax liability, it's going to be responsible for its own tax liability, which is a point that I didn't bring up with the 1065 and the 1120, the partnership and the S corp. There will be just to be clear, there will be no tax liability associated with those two entities because they do flow through. However, it's important that you timely file both of those types of tax returns, because as it is right now, the late filing fee on those two is $195 per partner per month it's late. So no tax liability, but some healthy late fees on those two.
And so based on what you're saying, it looks like what we need to do is you have to prepare those returns most likely first, right? Because
Correct.
In order to do your personal return, you're going to have to get these S corp, limited partnerships, those things got to be done because they're going to flow through to your individual. So
Exactly.
Okay. But the C corp is a little different. You don't necessarily have to have it done before, but I mean, from a date standpoint, it might have to be, but it doesn't flow through. So it's not going to have that same issue.
It doesn't have that same issue at all. Basically, the C corp I'm talking about the C Corp today because it is a valuable, like slide says, tax planning tool that can be used in concert with your LP or your LLC. Management fees, guaranteed payments, those end up as deductions on the LLC or LP that flow through to your personal tax return. So let's say that you have an LP and you want to go ahead and pay the corporation a guaranteed payment. You do pay the corporation a guaranteed payment. And that way that's treated is it's treated as a deduction on the partnership tax return directly against any income. So it's going to either reduce the income the partnership has, or it's going to cause a loss that flows through to your personal tax return that you can deduct against the rest of your income on your personal tax return. Or you can do a management fee. Management fee works a little different than the guaranteed payment. It's going to be a deduction that flows through your LP or your LLC, but that's going to more than likely land on your Schedule A as an itemized deduction. And that's going to be if it's an LP. If it's an LLC that is filing on your on the Schedule C we talked about, then the management fee is just going to be a deduction against the Schedule C income.
Got it. Okay. So deductions you wouldn't be able to take on your personal return, but you can do it on your corporate return. I know This is something that a lot of people ask about was, what are some of those deductions? So you've got a few of them listed here. Describe what those are.
Well, I wanted to touch on that because while we did go ahead and do a management fee or a guaranteed payment to cause that deduction on the personal side, we're now putting income into our corporation. So how are we going to reduce that income? Medical expenses is one example. That is a deductible expense on your personal tax return. However, there's the 10% AGI or adjusted gross income limitation. What that means is first you have to calculate a 10% of your adjusted gross income, and then anything above that 10% is what would be deductible on your personal return. So you're already losing out on 10% of your medical expenses. Whereas on the C Corporation, it's 100% deductible. Education expenses, extremely restrictive on your personal tax return. 100% deductible on a C Corporation, expected on a C Corporation. The Section 288 deduction or the meeting room expense, really cool deduction there. You can have a meeting you can rent a room in your home to the corporation for up to 14 times throughout the year without it having to be reported as income to you personally, but it can be reported as a deduction to the corporation.
I like that one. I need to be doing that.
Yes.
Yeah. So let me just go back real quick on the education one. I would assume there's some limitations for even the C Corp on what the education expense. I mean, we're not talking about like college or something like that. Or are we? Can you deduct things like that?
Yeah, you can deduct tuition reimbursements. Okay. Really, what that's about is making sure you have all of your paperwork together too.
Got it. So as long as we've documented it and it's a benefit to the business, then it is something that could be deducted.
Yes. Okay. And it's all a case-by-case basis. As well. So you do want to make sure you get with your tax professional, give one of us a call. We're always here to help. So if you're spending money on something throughout the course of running your business and you're not sure if you can take that as a deduction or not, quick call and now you know.
Got it. Great. So business use of the home. I know a lot of people are working out of their home, especially these days. So what can be deducted, what can, and in what area? So give us a rundown of this.
Well, the business use of home deduction, you can take this deduction if you have a room in your house, a space in your house that is exclusively used for the business. You can't do any kind of personal activity in that room. Another thing IRS points out is if you have a space to work outside the home, this is obviously something that they're going to scrutinize in that case.
So if you're working in an office and you have rented an office, but then you're also trying to take a home deduction, they're not going to probably allow it.
Probably not.
Okay.
Now, when you're taking a deduction, there's two different ways that you can go about it. The simplified method, I believe IRS just put that out in 2013, I believe. So the regular method is what we've all been using. And that's your actual expenses. It's based on the percentage of the home used. And basically, we're talking about things like your mortgage interest, your real estate taxes, perhaps your home insurance, repairs and maintenance. Whatever percentage of space is being used, that's the percentage of those items that's going to be deducted as the business use of home deduction.
Is utilities part of that? Or
utilities can also be part of
okay.
that.
So the utilities, all those things, if I'm spending $5,000 a month for all of that stuff, and I have 10% of my house is being used only for my business, I can write off $500 on my business.
Right.
And
now,
this is for what type of entity can take this deduction? Any of those that we've gone through, or just for some?
all but the C corporation.
Okay.
C corporation, of course, would be deducting it a little bit differently on the C corporation return.
Okay.
Also on the regular method, with the regular method, you're going to be depreciating your home, or at least the percentage that you're using for business. Downside to that is, I mean, it's great, you get the deduction, but when you go to sell your home, you have to recapture that depreciation. So it's going to reduce the cost basis of your home when you're reporting the sale.
Got it.
Okay. Now the simplified method, a little different, a little easier. It's going to be based on square footage. And there is a limit on that. It's limited to 300 square feet. $5 per square foot is what you get. So
that's actually pretty good. It's $1,500 a month.
The maximum amount.
Max.
No, 1,500 total.
Yeah. $1,500 total for what? For a year?
For the year.
Oh, that isn't so good.
It's not. It's not. But here's the thing: you get all of your full. If you're itemizing, this is probably a better method for you, because you're going to get the $1,500, and you're going to get to deduct 100% of your mortgage interest, your real estate taxes, any qualified mortgage insurance premiums you have. You're going to get to deduct those 100% on your Schedule A.
Okay.
Okay. Whereas with the regular method, you brought up 10%. 10% of the mortgage interest and those things I talked about is what's going to be deducted as a business use of home, and then the remainder will be deducted on the Schedule A. So the simplified method is probably a little bit better if you're itemizing.
If you're itemizing that. Okay, great. Good to know. So those if we're itemizing, we should look at simplified.
Correct. And no depreciation here. So you don't have to worry about depreciation recapture on the back end.
That's big right there. You just switched me. I'm going to because I was thinking about that as you were describing it, and I'm thinking, man, number one, just having to track that. I don't know if you sell your house 10 years later and having to go back and recapture all that. It just, man, it'd be a pain to sit there and try to figure all that out. All right. So anything else in terms of some of these things that you'd want to make sure we point out before we end the webinar today, kind of talking through all of the topics we've gone through?
Well, just one item I don't think that I did mention, that when we talk about passive losses, they're not just gone because you didn't get to take it in that tax year. It does carry forward. And you'll be able to take it against all of the great income you're going to earn in that following tax year.
Got it. That's good. Good deal. So for those that are listening in, we wanted to point out a few things for you. Number one, if you haven't got your tax organizers yet, the tax organizers are what we ask you to fill out for doing your tax returns for you. So you can obviously go directly to dganderson.com. Look for the tax organizers link. It'll take you right to that. You can download. This year we actually let you even fill them out directly online. So you can do that. You can save it as you're doing your work, all that kinds of stuff. 1099s, those are due January 31st?
January 31st. The majority of the 1099s that we're looking at are the 1099 miscellaneous, 1099 INTs. 1099 miscellaneous, you're required to file if you've paid an outside service or outside contractor vendor over $600. If you've paid them by credit card and they're reporting on a 1099-K, then you're not required to do the 1099 miscellaneous. 1099 INT is going to be for C corporations and S corporations. If you have shareholder loans, outstanding shareholder loans on the books over $10,000, you're required to impute the interest on those and go ahead and file that 1099 INT. So give us a call ASAP so we can get those filed for you. If you're not sure if you need to file those, still give us a call so we can figure it out.
Yeah, I would definitely give us a call on the 1099s to make sure all those get distributed, because obviously I'm assuming there's probably late fees or something.
Yes.
Yeah, I'm sure there's something there. The IRS loves to issue late fees, so I'm sure there's something there. All right, so upcoming tax deadlines, March 15th is the S Corp
Yes.
tax deadline. April 15th, I think everybody knows that one. The individual, my best friend has his birthday April 15th. I always remember to call him on April 15th, and he hates it because he goes, I don't remember anybody else's birthday, but everybody remembers mine. And it's because of that.
If anybody is thinking about a career in tax, if your birthday is on April 15th, give it up.
Yeah. Yes. That would not be good. So the next webinar is with Elliot Thomas, is one of our tax professionals here for next February, the third Wednesday. Topic is to be determined. He will be working with us on that. And again, on the tax organizers, just make sure you go in there and download those. But at the same time, if you have any question whatsoever about having us do the tax returns for you or doing the 1099s, give us a call here at the office and we'll be happy to walk you through what the steps are to do that.
Absolutely.
All right. Well, thank you very much, Toni. And thank you, everybody who joined the call today.